what's up everybody? It's your mortgage expert, Brian McCauley here. So interest rates are dropping. You're thinking about buying a house. Better yet, you even own a house and you're trying to figure, when should I refi? When's the boom gonna happen? When am I gonna miss out? And when can I time everything perfectly so I can have my cake and eat it too? Well, stick around in this video. I'm gonna teach you everything you need to know. So the time is finally here. Interest rates are continuing to decline. I think we have another good possible year in front of us as rates will continue to get better. But I'm pretty shocked that things have dropped over a percent plus in the past couple of months. It's put people in a lot of really good positions to save some money. I've seen more pre-approved clients come off the sidelines quickly to try to go buy a house because now that interest rates are somewhere in the low to mid sixes, it's given them a lot of affordability. But what I'm seeing a lot more of right now is refinance clients. Refinance applications are up almost 40%. There are a lot of people out there that did temporary interest rate buydowns. They closed on a loan that had 7, 8, 9%, and they are ready to reset the payment, save themselves some money, get themselves in a much better long-term position, and be super happy that they've got a home. They're gonna have to avoid the boom with all the craziness in the streets in 25, and they're just excited that they're gonna be able to save a couple hundred to a couple $1,000s each month or each year long-term. So the big question is, okay, the refi boom is on us. It's not major yet, it's minor, but literally every week I can feel it inching up and heating up because as interest rates continue to drop, more people get excited. Now, refinances have a lot of different options and different angles on how people can really qualify for a refinance, but more importantly, why do you want to do it? I could spend hours on here, but I will just tell you that there are 4 or 5 major things that I think people should pay attention to when it comes to refinancing. So the first thing is, how can you save the most money on the payment? I don't want people to look at rates because while it's a factor, it's not as important as you think. Regular consumers say, oh, I want a cheaper interest rate. Why? Well, it's really so I can lower the payment. So what the goal should be is, how do I get the most savings out of the payment? Now that can be a combination of factors. It can be just the interest rate only. It could be the interest rate and getting rid of PMI. It could be as simple as converting from an FHA loan that has monthly MI and getting to a conventional loan with a cheaper rate, but maybe you don't have any PMI. So there's a lot of ways to bake the cake, right? But the primary focus should be on, how can I get my monthly payment the lowest possible so me as the consumer can save as much money as possible. And the truth of the matter is, while the interest rate is an important piece, it's not the only thing, and there are a lot of other factors that can help. And I will just tell you that the rate plus getting rid of PMI are a couple things that people need to pay attention to. I just had a client that we refinanced from the mid 7s to the mid 6s. It saved him about $210 a month on the mortgage payment alone, which is okay, but it's not great. Well, when he bought his house, he only put 5% down. He's got over 20% equity now. That PMI on his loan at the time was $310. So now with the refinance, we are getting rid of the PMI. So you see, if we just looked at the rate on that, it would only save him $200. And it's kind of like good, but not great. Now that we're getting rid of the PMI and lowering the interest rate over 1%, those two combined payment savings, getting rid of PMI is $500 a month. That makes it boom. That's worth it. And so that's why I want you guys to focus on the bottom line payment. How can I save the most? And when we do these annual reviews and we're talking to clients, we're going through all the strategies and scenarios to do just that. Second thing is, I don't want people that are refinancing to look at a 30-year fixed loan. I don't think it's a great loan. I'm 43, I've had 4 or 5 houses. I've never kept a house more than 8, 9 years. I've never kept a loan more than 5 to 7. So you wanna consider, if you qualify and if it's a good option, at looking at an adjustable rate mortgage. They are good mortgages. They got a really bad name a long time ago in the subprime market where there were 2-year adjustables with prepayment penalties and all these things. Those were bad adjustable rate mortgages and they never should have been around. The ones that are available now are on 30-year notes. They're fixed for 5 years, 7 years, or 10 years, depending upon what the person wants, but they're fixed for a long period of time. They don't adjust until that term is up, and 99.9% of people get rid of that mortgage before it even gets to a place that it could adjust and get them to a risk, whether that be refinancing, selling, paying it off. But I will tell you that most people between the ages of, probably 28 to probably 45, again, they're only keeping that house for probably 5 years, maybe 7. First time house, move up buyer, maybe even where I'm at is a third house, and we've been here for 8 years. We're getting ready to sell hopefully in the future, but this is the longest house that I've had. So even on an 8-year house, I got a 30-year mortgage, but I refinanced during the COVID boom and got a super cheap rate, but I'm on a 7-year ARM, which means I'm fixed for 7 years. I don't have any worries because I've got 2 years left on that ARM. We're gonna sell sometime in the next 3 to 6 months. So I'm gonna get rid of that adjustable rate mortgage before it even gets close to the adjustable rate period. And I tell everyone this, why? Because adjustable rate mortgages have more competitive rates than 30-year fixed products. Well, how does it work, Brian, and how much better is it? Okay, so for an example on this illustration, if a 30-year fixed mortgage today is 6.5%, what happens is maybe a 10-year ARM is about a quarter cheaper. So let's say it's from 6.5 to 6.25. A 7-year ARM is probably an eighth cheaper than that. So it goes from 6.25 down to 6 1/8. A 5-year ARM is probably cheaper than that. So it goes from 6 1/8 to maybe 6% or 5.99. Now, what we have to do in a mortgage planning session and a refi strategy session is say, hey, how long do you plan on being in this house? Best case and worst case scenario. If somebody says, oh, well, we've been in this house for 3 years already, we're probably gonna keep it for another 4 or 5 years, our kiddos are growing up or whatever the case is, and new schools, blah, 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 you'd be okay to take a 7-year ARM. Because if you have 7 full years from a refinance starting today until the time that it's going to adjust, if you know for sure that you're going to be out of that house, you can have all the reward, which is a much lower interest rate and a much lower payment with eliminating all the risk. So I want to be clear on ARMs. They are great programs. They save people a lot of money. Most people, again, are usually good with a 10-year ARM or a 7-year ARM that gives you a long runway, probably the time you're going to be in the house or just short of, to where there's no reason to take a 30-year fixed. You're not going to be there for 360 months. You're not going to make 360 payments. So it's a strategy play, which is, look, if you can get a much lower interest rate on an ARM, save yourself an extra, I don't know, $75, $100, $200 on the payment, and you know you're not going to put yourself at risk by letting that ARM adjust, please do yourself a favor and consider an ARM on a refi, because again, that can help the bottom line total payment become cheaper. ARMs are becoming more popular. I have one, so it's something to consider when doing a refinance analysis. Another big benefit on a refinance is cashing out. Now, I don't recommend this to everybody, but some folks need it, where let's say, hey, my mortgage rate is 7.5 right now. I'd like to refinance down to a 6.5, and I'd like to maybe get rid of the PMI or reduce it. And so, my monthly savings are, going to be $400 on the mortgage, but, I'm only at a 70% loan to value because I paid my mortgage down and my house has gone up over the past few years. I've got some equity, AKA my house is like a mini ATM. I've got some equity there to play with. And so I always tell everybody, hey, if you're going to refinance, right, and you have any other debts that you want to eliminate by using the equity in your property, consider it. Why? I call it compound savings, and I'm going to talk about a short, quick way to do it without pulling cash out. But for this one, I'm going to talk about, hey, if somebody's refinancing and they're lowering the rates, lowering the payment, getting rid of reducing the PMI, but let's say somebody has a $20,000 credit card. They've run up debt during this crazy economic time. There's inflation. They've obviously had to use the credit card to get themselves by, maybe float some bills like we all have, tried to get it all done. But let's just say they've got a $20,000 credit card and that credit card payment is, costing them $400 a month. And so obviously they want to get rid of that and they want to put themselves in a position to, decrease overhead, increase cash flow. But obviously we've got to structure that accordingly. So there could be a 2-part piece on these as well, which is, hey, we can lower the interest rate, we can get rid of the PMI, put those combinations together. And obviously you may save $400 or $500 a month. But if we see the opportunity to say, hey, well, you've got some good equity in your house, I don't want to tap into all of it and waste it. But what I'd like to do is you consider, hey, you've got a $20,000 credit card bill with the monthly payment that's $400 a month. Instead of just borrowing what you owe on the property, why don't we borrow what you owe, add $20,000 to it so we can take some equity out and then use that $20,000 maybe to pay off that credit card or that higher debt that's $400 a month. And now all of a sudden, yes, you're financing an extra $20,000 out of the equity, but what you're saving on the mortgage and the rate and the payment and the PMI and all that, you combine that with an equity play and pay off some additional debt that you currently have to put yourself in a better financial position. And the $400 over here just on the refinance and the $400 over here that we paid off on the other debt, those combined is about $800 a month. And so that starts to put people in a much better position when they can think of multiple plays that can be done when it comes to refining and how to strategize and use every resource that you have in order to maximize your savings, short-term and long-term. Last but not least, it is a debt consolidation compound play without touching the equity. So let me explain what I mean. We've discussed a lot of things on refis, on how to make it work, the different combinations. There are probably 5 to 6 more I can show you on shortening the term, changing the loan product, paying cash out on debt. But one of the things people need to know is that whenever you are refinancing, there are closing costs, okay? People always ask, hey, if I want to refinance my mortgage from 7.5 to 5.5, that saves me a pretty good amount of money. But the problem is, Brian, I have to pay closing costs again. It's gonna get really expensive. Well, the truth is you have to know how the break-even analysis and the break-even point works to figure out, hey, is it worth it on a refi to do it? Now, a lot of people right now need the extra money, so they will refinance just to get relief in the rate, the payment, the savings, and the PMI. But 2 big things to remember when you refinance. Number 1, the closing costs that are required on the transaction do not affect you from an out-of-pocket expense standpoint. You can roll the new closing costs into the transaction to cover up on all those fees, so you as the consumer don't have to come out of pocket. So if you're gonna refinance, save a % or 2, get rid of some PMI, save $400 or $500, but it may cost you 6, 7, 8 grand on the closing cost piece, you can roll that into the loan, no out-of-pocket expense, reset the term, you get the savings. Here's the fun part. This is the extra little mini cash out that I had discussed earlier that I wanted you guys to wait around for, because a lot of people can do this when they can't cash out or they don't want to. So let's say on the credit card example, maybe you've got a credit card with $12,000 as the balance and not 20. And instead of that payment being $400, maybe this payment is $250 to $220. So if you don't have the equity or you don't want to touch into the equity, what you can do is when you roll those closing costs in the transaction, we as the lender can set it up to where you skip 2 payments. So let's say your payment was $5,000 a month. If you were to close hypothetically in October, we would set it up to where you close in October, you would not make October's payment, we would include that in the payoff, so you would keep October's $5,000 in your pocket. Obviously, you skip the first month on a new mortgage just like you do on a purchase, so you'd skip November, okay? Your first payment will be due December, but that November payment that you would normally pay sits in your pocket as well. So now you've skipped October, you skipped November, the $5,000 a month that was gonna cost you on the payments all in, you've kept that money in your pocket. Now you have an additional $10,000 in your pocket, and you can take that $10,000, go apply it towards that $12,000 balance on the credit card and get that balance down from 12 to 2 and get that monthly payment down from $240 to maybe $40. So what happens is you pick up $200 in savings just by strategically not actually cashing out on your house, but using those 2 skip payments and sometimes an escrow refund, which I'll talk about in another video, and take that money and use it towards other debt. And then what happens is if you are saving $300 in the mortgage, $200 on the credit card because you've used those skip payments to pay it down, now your total savings to you as the consumer is $500, and it continues to sweeten the deal. So these are things that you need to consider on a refi. They are all worth it. Every person's situation is different and unique. You have to figure out all the details and specifics on what's most important to you, how to put together the puzzle, how to set up as many skip payments and escrow refunds and lowering PMI and all these things, because again, it is a combination of layering things together, adding and removing to maximize the overall savings for you as the consumer, which we do in each individual refi analysis call. We just have to figure out exactly what your situation looks like, what you need, how much can I help move the pieces of the puzzle around, and obviously is now the right time or should you wait? That's to be determined depending upon how quick interest rates go down. But the good news is a lot of savings are in store in the future for folks. We just got to figure out how to do it and figure out the right time. So listen, if you found this video useful, do me a favor, like, comment, subscribe, even share it with somebody that you could know that could benefit from maybe a refinance analysis for myself and the team. And if you want to find out about your current situation, whether it be a refinance, purchase, learn how to put together income, learn how to put together your credit, learn how to put together a package to potentially qualify for a home loan, do us a favor, reach out to us. We are always here. Call us, email us, text us. We will make time, and we appreciate the opportunity. Until next time, stay tuned.